What is money? Not the notes in your wallet or the numbers in your bank app, although those are its most familiar faces. Money is an idea made tangible. It's trust organized into a system, a language we all agreed to speak so that value could travel between people, places, and time. Think about a farmer who has extra rice and a carpenter who has extra chairs. If the farmer needs a chair and the carpenter wants rice, they could trade. Simple. Barter works when wants align. But what happens when the farmer needs shoes, the shoemaker wants salt, and the salt miner wants rice? Suddenly, trade becomes messy. Money emerged to solve that mess. It turned value into a portable, divisible, and widely accepted medium. The earliest forms of money were things with intrinsic value: shells, beads, grain. Then metals like gold and silver became popular. They were durable, rare, and easy to divide. For centuries, gold was the anchor of trust. Emperors stamped coins with faces and symbols to certify weight and purity. That stamp was a promise. This coin holds value. Fast forward to the 20th century. The world moved from metal-backed currencies to promises backed by governments. Fiat money. Modern cash is valuable because people believe in the institutions that issue it: central banks, governments, the rule of law. That belief powers the global economy. When trust in those institutions cracks, money's value does too. Money is more than a tool for buying things. It's a store of value, a unit of account, and a medium of exchange. As a store of value, it lets you shift purchasing power from today to tomorrow. As a unit of account, it gives us a common measure to compare prices. As a medium of exchange, it lubricates interactions in a complex society. But money also shapes human behavior. It creates incentives. It can motivate innovation and productivity. It can also distort priorities, turning what should be means into ends in themselves. Entire cultures evolve around what people value and how they distribute money. Wealth concentration and poverty aren't only economic facts. They reflect social choices, laws, and history. Consider credit. Credit lets people and businesses act today on the expectation of tomorrow's income. Credit financed the Industrial Revolution, helped businesses scale, and enabled individuals to buy homes and start companies. But credit can also lead to cycles of boom and bust when expectations outpace reality. Bubbles form when speculation detaches from fundamentals, when people believe prices will rise forever. When the tide goes out, consequences ripple through banks, jobs, and homes. Money's power is magnified by institutions. Central banks control interest rates and the money supply to manage inflation and employment. Governments set taxes and budgets, steering resources toward priorities like education and infrastructure. Regulatory systems shape markets, enforce contracts, and limit fraud. The architecture of institutions determines how smoothly money circulates, who gets access to it, and who is left out. Access matters. Financial inclusion, access to banking, credit, and investment, transforms lives. Imagine the farmer with no bank, cash under a mattress, exposed to theft and loss. Now imagine that same farmer with a mobile account, savings, microloans, insurance. In many parts of the world, mobile money has leapfrogged traditional banks, bringing millions into formal financial systems. Technology changes the game. Over the past decades, digital payments have exploded. A smartphone can now replace a wallet, a bank branch, and a broker. Digital transactions are faster, cheaper, and more traceable. They can expand access, but they also concentrate power in platforms and create new privacy trade-offs. And then there's the rise of cryptocurrencies. Bitcoin began as an experiment, a decentralized ledger designed to resist censorship and to create money without a central issuer. Its promise: trust built on code and cryptography rather than institutions. Cryptocurrencies inspired a wave of innovation and a debate. Can we reimagine money for the internet age? The answer is not simple. Crypto offers new primitives: programmable money, tokenized assets, permissionless finance. But it also faces volatility, regulatory questions, and real-world usability challenges. Whatever form money takes, it is deeply political. Who controls money decides which values get prioritized. Monetary policy can be used to stabilize economies, but it can also be weaponized. History is full of examples: hyperinflation shredding savings, currency controls trapping capital, or sanctions cutting nations off from global markets. Money can be a tool for empowerment or a lever of oppression. On a personal level, money intersects with choices, identity, and security. How we earn, whether through entrepreneurship, salaried work, or investment, shapes daily life. How we save and invest determines future options. Money can buy comfort and opportunity, but it cannot guarantee meaning. People often chase money hoping it will solve deeper needs: belonging, status, or purpose. Sometimes it does, often it doesn't. Let's pull back and look at money through three lenses: history, technology, and inequality.
And then there's the rise of cryptocurrencies. Bitcoin began as an experiment, a decentralized ledger designed to resist censorship and to create money without a central issuer. Its promise: trust built on code and cryptography rather than institutions. Cryptocurrencies inspired a wave of innovation and a debate. Can we reimagine money for the internet age? The answer is not simple. Crypto offers new primitives: programmable money, tokenized assets, permissionless finance, but it also faces volatility, regulatory questions, and real-world usability challenges. Whatever form money takes, it is deeply political. Who controls money decides which values get prioritized. Monetary policy can be used to stabilize economies, but it can also be weaponized. History is full of examples: hyperinflation shredding savings, currency controls trapping capital, or sanctions cutting nations off from global markets. Money can be a tool for empowerment or a lever of oppression. On a personal level, money intersects with choices, identity, and security. How we earn, whether through entrepreneurship, salaried work, or investment, shapes daily life. How we save and invest determines future options. Money can buy comfort and opportunity, but it cannot guarantee meaning. People often chase money hoping it will solve deeper needs: belonging, status, or purpose. Sometimes it does, often it doesn't. Let's pull back and look at money through three lenses: history, technology, and inequality. Historically, money evolved to solve friction in exchange. The systems we built reflect scarcity, trust, and cooperation. Each transition, from commodity money to coinage, to fiat, to digital, solved problems but introduced new ones. The move from gold to fiat allowed flexible monetary policy, but made trust in institutions paramount. The rise of digital money increased convenience, but concentrated data and control. Technologically, new layers keep forming. Fintech is not just about replacing banks, it's reimagining how financial services are delivered. Faster payments, fractional investing, embedded finance inside apps. Decentralized finance promises permissionless markets and composable financial primitives. Artificial intelligence can personalize financial advice and detect fraud in real time. All these technologies expand possibilities for efficiency, inclusion, and new business models, while raising questions about ethics, security, and oversight. Inequality threads through every commentary about money. Wealth today is highly concentrated. A small fraction of people control a disproportionate share of global assets. This concentration is not inevitable. It emerges from policy choices, tax systems, property rights, and historic power dynamics. Addressing inequality is both moral and pragmatic. Societies with extreme inequality face political instability, weaker growth, and lost human potential. The tools to counter this range from progressive taxation and public investment to education, universal basic services, and targeted financial inclusion programs. Each has trade-offs and political resistance, but the underlying problem is clear: how money and policy distribute opportunity shapes generations. Money also defines markets for ideas. Venture capital directs capital to startups, shaping which technologies and solutions get scaled. Advertising dollars direct attention and culture. Philanthropy redistributes wealth toward causes that donors choose. These flows of money influence values, innovation, and the future of industries. The entrepreneur's perspective matters here. Capital is oxygen for startups, but the terms of capital — control, dilution, expectations, determine the path a company takes. So where is money heading? A few trends are worth watching.
First, digitization will continue. Cash usage declines and central banks explore digital currencies. Central bank digital currencies, or CBDCs, could reframe how monetary policy works and how payments happen. They promise efficiency and inclusion, but they also raise privacy concerns and questions about financial intermediation. Second, programmable money. Smart contracts enable money that enforces rules automatically. Conditional payments, automated payroll, trustless escrow. This could reduce friction in commerce and open new product categories. Think subscription services with built-in micropayments or supply chains with automated settlement. Third, financialization of everything. More assets will be tokenized: real estate, intellectual property, even fractions of art. Tokenization could unlock liquidity and broaden access to investment, but it will require robust legal frameworks to protect rights and resolve disputes. Fourth, shifting geopolitics. The dollar's dominance gives the United States extraordinary financial power, but geopolitical tensions, alternative payment systems, and regional blocs may create a multipolar monetary world that would alter trade, finance, and the leverage nations can exert. Lastly, human choices will matter more than technology. Systems can be built, but values decide how they are used. Do we design money systems that prioritize short-term profit or ones that factor in long-term stability, fairness, and sustainability? That's not a purely technical question. It's ethical, political, and practical.
At the level of everyday life, money literacy is a superpower. Understanding how interest compounds, how inflation erodes purchasing power, and how diversification reduces risk changes decisions. Small choices, starting to save early, automating investments, negotiating compensation, compound into very different outcomes over decades. Yet financial education remains shockingly scarce. Empowering people with tools and knowledge can create resilience and opportunity. There are myths to dismantle. Wealth is not just luck, nor is poverty always the result of bad choices. Structure matters. Access to quality education, social networks, fair credit, and stable institutions shapes outcomes. Another myth: money will make you happy. To an extent, money reduces stress tied to scarcity, but beyond a threshold, additional income has diminishing returns on well-being. The challenge is to use money to buy freedom, security, and the time to pursue meaningful projects. For entrepreneurs and creators, money is both resource and signal. Funding allows growth, but it carries expectations. Revenue and profitability create independence. The smartest founders learn to balance fundraising with sustainable business models. For creators, monetization strategies now span platforms, sponsorships, memberships, and digital products, an ecosystem where community often trumps scale. There's also a moral dimension. How we accumulate and spend money leaves footprints. Investment choices can fund destructive industries or fuel transition to cleaner energy. Consumers' purchases reflect values, and investors' capital allocates resources. The age of conscious consumerism and impact investing shows that money can steer markets toward social and environmental goals, if enough people decide it should.
Let's return to trust, the heart of money. Trust can be built by institutions, code, or community. Local currencies and time banking experiments show that tightly knit communities can create alternative exchange systems. Cryptographic systems aim to build trust without intermediaries. Governments provide broad trust through legal systems. None of these is perfect. Each has strengths and vulnerabilities. Money's evolution will likely be plural, multiple systems coexisting, interoperating, and competing. Imagine a day in the near future. You wake and pay for coffee with a digital wallet, the transaction routed through a payment rail operated by a cooperative of small banks. You send a micro-donation to an artist using a stable token that automatically splits fees among collaborators. Your retirement contributions are invested in tokenized real estate and green bonds, rebalanced by algorithms that interpret your values. Your country's central bank adjusts monetary policy with real-time data to smooth shocks. None of this is fantasy. Pieces already exist. The challenge is integrating them in ways that preserve privacy, fairness, and stability. Money has always been a mirror. It reflects our priorities, our trust, and the society we build. When we change money, we change incentives and shape the future. That's why debates about monetary policy, financial regulation, and technology matter to everyone, not just economists. So, what can you do as an individual? Learn the basics: compound interest, inflation, diversification. Build multiple income streams, not as a hedge against effort, but as a way to funnel optionality into your life. Treat money as a tool for freedom, not as a goal itself. Use your financial decisions to align with your values, whether that means supporting local businesses, investing in sustainable companies, or donating to causes you believe in. And if you're building something, a startup, an app, a creative project, think not just about product market fit, but about money fit. How will this create durable value? Who benefits? How will capital flow? Money should serve the purpose you set, not the other way around. In the final analysis, money is practical and philosophical. It is ledger and language, machine and mirror. It enables civilization, concentrates power, and offers a canvas to design better futures. The systems we choose, from the rules that govern banks to the code that verifies a blockchain transaction, are collective choices. They encode who we trust, what we prioritize, and how we share prosperity. If there is one takeaway, it's this: money is not an abstract enemy nor an untouchable force. It's a human creation. And like all human creations, it can be redesigned. We can build systems that distribute opportunity more widely, that reward long-term thinking, that respect privacy, and that make prosperity sustainable. That requires ideas, discipline, and the messy work of politics and engineering. It also requires imagination. What future do you want money to enable? The answer shapes the world we're building next.